Have you heard someone talking lately about how they're trading their futures account and thought to yourself, wait, what the heck is a future? Or perhaps you've seen a post on Reddit showing the incredible gains and losses that can be made through trading options, but you have no idea what an option is. Well, by the end of this video, you'll know the difference between the two, their strengths and weaknesses, and most importantly, which one may be right for you to trade personally. Hit that like and subscribe, and let's get into it. To understand options and futures, the very first thing we need to know is that the most basic level of investing is either owning an asset or a stock. But how do stocks work? Well, if I buy one share of Google stock at $100 a share, and the price of Google over the next month goes to $110 a share, I have made $10 since I bought the stock. But what if it took me longer than a month for the price of Google to go from $100 to $110? What if it took me an entire year?
Oh my God! Okay, it's happening. Everybody stay calm.
What's the procedure, everyone? What's the procedure?
Stay calm.
Well, since I own this share of Google, I have theoretically unlimited time, and this will be a key difference when we start talking about options and futures right now.
Get on with it!
Now that we understand how assets and stock work, we can now move on to level 2, which is derivatives, and includes options and futures. But what even is a derivative?
And here we go.
Well, derivatives are financial contracts that derive their value from the price of another asset called the underlying asset. And though this may sound very confusing at first, we can simplify things a lot if we just go back in time. Well, several hundred years ago, people could only trade the stock market by buying or selling shares of a stock. And eventually, this just wasn't enough for people. They decided that they wanted more. But Zach, what did they want more of? Leverage. Now there is actually some very interesting history for why these contracts started coming about that I will likely cover in a different video. But essentially, people started making side bets based off of time. In fact, you could say it's all
about time.
See, in our example earlier where we owned one share of Google, we could hold it as long as we wanted because we owned the share. But now people decided to start making bets where time was limited. People started saying things like, hey, if you pay me $100 and Google goes to 110 by the end of next week, I'll give you $1,000. But if it doesn't get there, then I'm going to keep everything. And thus, the derivatives market was born. And now that we understand why they came about, let's get into how they work. Options are derivatives contracts that decay over time. They are divided into two groups, calls and puts. If you think that the price of a stock is going to go up, then you would buy a call. If you think the price of a stock is going to go down, you would buy a put. Understanding how options decay is important, and to do that, we need to look at a couple things called the Greeks. And no, not these guys. The Greeks are a couple of mathematical constants that determine how the value of an option goes up or down. And while this list of Greeks is intimidating, in my opinion there is only two main ones that you need to worry about.
Oh, thank God.
Delta is essentially how far away you are betting the stock will go relative to where it is right now. And theta is how much time you have for the stock to get there. As we mentioned, options decay over time, and that means they have what is called an expiration date. In our Google example from before, our expiration date was 1 month from when we bought the call. And we said that Google is going to go up $10 or more over that month. If it does, we could make a lot of money. But if it does not go above $110, we are not going to make anything. In fact, we will lose everything that it cost us to buy that call. This highlights the worst part about options, which is you can be right about the move a stock is going to make, but you can lose just because you didn't have enough time. Pretty crappy, huh?
Yup!
So let's summarize the pros and cons of trading options. Pros. You get way more leverage than just owning a stock, and you can only lose whatever it costs for you to buy the option. And if you are right about the timing, you can make so much more than just owning shares of a stock. Number 2, there are many indexes and companies that you can choose to trade options with. In fact, almost every publicly traded company offers some degree of options trading. Alright, now let's move on to the cons of buying options. Number 1, and this is a big one, time decay. You must be so right about when you buy an option, because if you don't give yourself enough time, even if the right move happens, you won't make a dime. And that is not the only decay that you have to worry about. You can also see decay on the option's value based off of other things that you weren't even anticipating, such as events or earnings. These things can inflate the price of an option so that you pay a higher price for it, but after these events happen, the price of the option will go down dramatically, leaving you with a large loss. And with all of these things that can affect an option's price, they really are not that friendly to beginning traders. And actually, sometimes even if you get the move in the right direction, you can still lose money because of all of this other decay that has happened to the value of the contract. So again, if you are a beginning trader, I do not recommend buying options as your first experience. Now, one last thing to note is that all of these pros and cons apply to buying options. The exact opposite of all of these things can be taken into account if you sell options. But since most people buy options instead of selling them, I'm focusing on that, and I will likely make a video on selling options later.
How long is this going to take?
Alright, now that we've discussed our other options, let's get into futures.
Get on with it!
Now, lucky for us, futures are actually quite a bit easier to understand than options due to a couple of things. 1, they don't have time decay like options do. And 2, if you get the move, you'll get paid. Unlike options that can have an ambiguous amount of money that you're going to make if you get the right move, there are no Greeks with futures, which means if you get the move, you know exactly how much money you're going to make. But how are futures different than stock then? Well, futures came about because of farmers. Farmers needed a way to stabilize prices, and so they created the futures contracts. By buying or selling a futures contract in their certain crops such as wheat, corn, or cattle, they were able to protect themselves from the fluctuations in price. This also meant that futures contracts needed to have an expiration date to them, so that at the end of a certain amount of time, people would have to either buy or sell that respective commodity that they had agreed to. But wait, I can hear you saying, you said there's no time decay, and that is still true. There is no decay of the value of your futures contract going right up to expiration date. The only difference is if you are holding past expiration date, you will be on the hook to either buy or sell a large amount of a crop or oil or natural gas. So unless you're a farmer or a large store, don't hold these contracts past expiration date.
Cool.
So now that we understand what futures are and why people trade them, let's get into the pros and cons. Pro number 1, no time decay. Pro number 2, no ambiguous pricing or artificial inflation of contract prices. If you get the move, you're going to get paid a certain amount of money, or lose a certain amount of money if it goes against you. Pro number 3, different markets to be traded. Not only can you trade commodities such as corn, wheat, or oil, you can also trade on major stock indexes such as the S&P 500 or the NASDAQ. And pro number 4 is prop firms. There are companies right now that will give you money to trade with if you can prove that you are a profitable trader, which can make getting into trading much less expensive for beginners. Now let's get into the cons. Futures do not have any individual or publicly traded companies that you can trade. They are exclusively commodities, indexes, or crypto. This isn't necessarily even that big of a con, but if you believe in a company like Google and you want to trade them, you will not be able to do that with futures. Con number 2, less leverage than options. I believe this could be considered a pro as well as a con, but because of the unambiguous pricing of futures contracts, you will not have a piece of news come out that's going to inflate the value of your futures contract like you could with options. And there you go. You now know the basics of how options and futures contracts work, but which one is right for you to trade? Well, I believe that this is going to strongly depend on you.
So funny.
Are you interested in day trading, or are you interested in holding things for a longer amount of time? Personally, I believe that futures are superior to options for day trading because you know exactly what you're going to get if you get the move, and there is no time decay. I personally have day traded both, and I have had a much better time day trading futures than options. I think for longer time periods of trading, such as swing trading, options can be a good way to trade as long as you give yourself a lot of extra time to be right before expiration day. I also think that futures can be an excellent way of swing trading as long as you're okay with not trading public companies such as Google or Apple or Tesla, and as long as you do not forget to hold past expiration day. Do you have any personal experience trading options or futures? I'd love to hear about what you think about the differences between the two down below in the comments. See you guys next time.